a stop on the day and no target, that's the way you perform the most. And you can see it evidence there. You set a stop and you let your winning days go, i.e., you try and push this as much as you possibly can. Your goal on any given day is not to hit 500 and say, well, that ticks off the consistency box. Your goal on any day is to make as much money as you possibly can. What you don't know with trading, as I talked about in the first session, is when that day is. That's what's the difficult part of it. And that's where consistency can be tricky, because some people are going to be good at certain things. As the first slide said, consistency is applying an edge time and time again. It's the consistency of application of your edge over a long period of time, not the consistency of achieving the same amount day in, day out. Let's go and have a look at a couple of examples of how three completely different traders are all consistent. They apply their edge in certain ways. First up, swing traders. Look at the win rate on each of these. For each trader, that will barely change. What does change is the number of trades. 39 winning trades over the course of this last month. And you see where these are all grouped, little patches of winning trades here and there. Very, very erratic performance as well. You have to sit through long periods of not much going on. So there you go. You will probably see this, Jan, in just a moment. Just to give you a bit of context, each of these three traders that we'll go and look at all achieved around about the same amount. I can't detail precise numbers, but all towards the middle of six figures, let's put it that way. So swing traders. What's inconsistent with swing traders is the way the performance is achieved. You will have to sit through long periods where maybe you sit for a drawdown, maybe you get no performance at all. And then you will get these bigger jumps, because what's happening is you're recognizing where your opportunities come from. You go onto a news trader and you see this much more sort of stepped type performance. Still, not tons and tons of trades. 320 in the losses, 225 in the winners, roughly flat both ways. But look where the performance is. A few big performances, and this is over a certain period of time. This is this month, so you know what was going on over the early weeks of this month, the whole SVB crisis, Credit Suisse crisis, and that's where you get this very strong jump up in performance. Then, without the news, you get much flatter type activity. So again, you end up with this sort of stuttered equity curve over the course of a month. More round trips, more trades done, big swings up, and then flat. So generally what you're getting here is somebody who's not going to take the swing both way, but they're going to get this sort of stepped performance. Finally, you get someone who more leans towards being a scalper. What you end up with scalpers, still same rough 50-50 win rate. And well, actually, I say 50-50. The win rate for each of these traders is much more aligned with the sort of high 30s, low 40s. But look at the number of trades. Far, far more trades done. You're well over 1,000 losers, 600 winners. Much more consistent across the month as well. The grey, incidentally, is the total for the day. The blue and the red are the swings, the total P&L achieved on each day. So what you see basically is, for the scalpers, they're not taking big hits on the downside, very few down days. But what they're able to do is create this sort of smoother equity curve. You see it's much steadier towards the upside. Yes, it does have a few sort of bigger steps in it, say here, here. But on the whole, it's moving up in a much more steady way. This is, I think, what most people look for when they look for consistency. But what people often do when they look for consistency is also try and minimize costs at the same time. The best way to generate consistency is participation edge. The more you participate, the more you smooth your equity curve, because what you're doing is you're creating small wins, small losses. And over time, you're then going to generate more of those. When I say generate more winners, generate more payout on winners. You can see here, you're not generating more winners. What's happening is you're getting paid more on the winners. So when you see that the trade's working, then you leverage that trade up. That's how Scalpers are able to benefit from that participation edge and being more and more involved throughout the day.